Let's get to the panel. In PGIM's Greg Peters, Terry Jacobson of UBS, and Jim Bianco of Bianco Research. Terry, can I start with you? And can we do something really difficult together? Just try to put the emotion of the moment to one side and just ask ourselves, have the fundamentals changed? Italy have got a carve-out reportedly for luxury goods. The administration looking for a carve-out for energy. We're hearing that the Belgians want a carve-out for diamonds. I mean, Terry, what's changed as far as you're concerned?
Well, I think you put it best yesterday when you said that the tail risk is now our base case, and really everything needs to be recalibrated. The fundamentals in terms of earnings growth, the strength of the economy are still there, but investors are sitting on the sidelines because the world changed. The world changed very quickly overnight. This is a very humbling time for professionals in this marketplace, and I think we just need to tread very carefully.
We'll do our best to do that. Jim, you came out pretty early this week and essentially said, and I'll paraphrase, and you can clarify if you'd like, that this market was a measure of how serious the West were about containing the Russian president's aggression towards Ukraine. Is your conclusion that at the moment they don't seem to be that serious?
Yeah, unfortunately, that is my conclusion, because any kind of sanctions that you would put on Russia would have to involve some pain or discomfort in the West. And it's very apparent that nobody in the West really wants any pain or discomfort. So there's really going to be nothing of substance that's going to stop them. And if not, I think all we're going to wind up from this whole affair is looking at the issue in front of us. What was the issue before Ukraine? It was inflation. What is going to be coming out of this? Well, it certainly isn't going to be lower prices that's going to be coming out of this. It's going to be some version of higher prices, whether it's energy prices, whether it's food prices. Remember, 25% of all grain exports come from Russia and the Ukraine as well, too. So if all we're going to get out of this is high prices, it's just going to put more heat on the inflation story and probably put more heat on the Federal Reserve to raise rates, not to lower rates. I think that's why you've got the two-year note back above 160 this morning, because without changing the situation in the Ukraine, we're just going to go right back to, okay, the Fed's going to have to raise rates a lot of times to try and deal with inflation.
Let's round it up. We're there, 160 basically, up 2 basis points on twos. Greg Peters, do you share that conclusion?
Absolutely. I think it's really about the inflation and the reaction function of central banks. This just exacerbates it all. So, I think what we learned is that, we're not geopolitical analysts at all. And the focus should be on what's happening with the economy and inflation. And I think just makes it a really difficult backdrop for central bankers and investors, right? They're trying to thread the needle. So I'm more in the camp. I think the markets are too tone deaf here. I think they're applying the playbook of, typical conflict where there's, this big rally on the back end once it gets going. But I think that misses a central point where fiscal is going the other way. And what you're creating is more inflation and therefore more response by central banks. So I'm a little more circumspect than maybe some others.
Greg, I'm going to build that out a little bit more with you in just a moment. Greg Peters, Terry Jacobson, and Jim Bianco. Hearing from the Ukrainian foreign minister just moments ago saying this, to some European leaders who are still hesitant, each year at commemorative events, you say never again. The time to prove it is now. They go on to say, this is the foreign minister in Ukraine, Russia is waging a horrific war of aggression in Europe. Here is your never again test. Ban Russia from SWIFT and kick it out of everywhere. That's coming from the Ukrainian foreign minister. We'll catch up with Henrietta Trays of Vader Partners on sanctions a little bit later this hour. Up next on the programme, coming up, the morning calls and later, volatility in the equity markets. The Nasdaq 100 rebounding after briefly entering a bear market. That's coming up a little bit later. From New York, this is Bloomberg. I want to get straight to Greg Peters. Greg, you said something 10 minutes ago that I think is really important. When you observe monetary policy, you have to conclude there is an understanding about the reaction function, one. And then if you conclude there's an understanding, you have to try and conclude whether it's well priced. You got to stage one of that conversation, Greg, and said, basically, you don't think many people understand where we are right now with the reaction function of monetary policy. Can you go there again, Greg, build it out to where you think maybe we're mispriced as you look through the market?
Yeah, so I just think the ultimate path is one where just stick with the Fed for a moment, where the Fed is raising rates and then stopping. Right. And I think that's somewhat heroic. And so I think there's too much attention on the March meeting. I always felt personally that 50 basis point hike in March was somewhat heroic. So that's been backed off. I think that's appropriate to me. But I think that misses the bigger picture, which is the terminal rate just seems too low from a pricing standpoint in the marketplace. So if inflation continues to hit, and I think that's why this Russia situation is so important because it's driving that. I think investors are too comfortable with the resting place of the terminal value, which is, as it stands now, still supportive for risk assets. I think when that gets repriced, or if that gets repriced, I think it's a very different outlook.
Terry, I hear something similar. I hear it a lot. And for anyone that watches this program, they'll hear my guests say it too. They're not interested in the pace or even the lift off, 25, call it 50. Look at the destination. It's going to be really low. They won't go very far. And I'm comfortable with risk assets with that in mind. Terry, do you think we're drawing the wrong conclusion on that too? Well,
I think that both the breadth and depth of what the Fed does is important, because I think it sends a signal to the marketplace. If the Fed raises rates too high, too much initially and too quickly, I think it makes the markets concerned that the Fed is seeing something that the marketplace doesn't understand or doesn't see. So I think that they're both important. We do expect the Fed to raise rates. They have to. It's too much of a political issue not to. But we don't think that the rates are going to be more than the market can bear. So we do think that rates stay relatively supportive for the equity markets going forward. But there's no doubt that the Fed has to raise. There's no question.
Terry, can I push you on that a little bit more? When you say things like it can't be more than the market can bear, what does that actually mean? And isn't the objective to get tighter financial conditions?
Well, it certainly is to get tighter financial conditions, but it's also a question of how they do it. It's a question of, do they raise rates? Do they start to sell assets on the balance sheets? We're starting to get a lot of different information from the Fed in that there's not a lot of control on the narrative. And in their defense, they're working off models that have never been working through a situation where we have zero interest rates, a geopolitical situation, and a 7% print on inflation. So it's just a very difficult environment for them to read as well. But I think that the market can bear certainly the 3 to 5 interest rate hikes that is being priced into the market for now. It'll still be accommodative for the market.
Jim Bianco, your take, please.
Yeah, I think what Wall Street is general is having a very difficult time getting their head around is, what is the Fed's priority? Everybody assumes the Fed's priority is growth. Everybody frames the discussion about growth. Well, what's this mean for growth if the Fed is going to raise rates? I think the priority has been shifting to inflation. We should be asking, when is inflation going to be down low enough that they could stop raising rates? And unfortunately, a lot of people think that that's not till next year. And that's why I think that we dismiss this idea that they're going to raise rates 6 or 7 times. That's what the market is priced in, because we think about growth. But if we think about inflation and we go, if their priority is inflation, then they very well might have to raise 6 or 7 times. And if that means growth has to take a hit, because that's the objective, and asset markets are going to have some turbulence because of it, then so be it. That's the environment we're in right now. This is what happens when the Fed stays at 0 all the way to 7%. They don't have a thread the needle option. They've only got trade-offs. And right now, I think the trade-off they're going to pick is more about inflation and less about growth.
Greg, if that's the case, let's talk about market implications. Michael Hartnett of Bank of America put out this morning. The percentage of stocks in a bear market, 76% of the NASDAQ, 51% of the S&P 500. He went on to say the Fed is tightening into a crash and stagflation. Credit stock bear markets beginning. Now, it's pretty inflammatory stuff when you think about it, Greg. Beneath the surface, though, there's been some destruction in the equity market, some real destruction. I wonder, from your perspective, your view, Greg, when you look into the credit market, the degree of destruction you've seen.
Yeah, so I think directionally that's right. But I would push back on destruction. I think there's been very little. And I agree 100% with Jim's comments. I think the narrative is inflation. And let's be clear, that's a new narrative for most investors, right? That hasn't been part of the calculus since, the late 70s, early 80s. So this focus on financial conditions seems like a sideshow to me. So I don't think there's been much movement at all. So if you look at credit spreads, so just, the IG corporate market in the U.S., we're coming off the global financial crisis tights at 80 basis points. It widened to 120, but it's still tighter than where COVID started. So to me, value hasn't been created. I think investors are too quick to jump on, it's cheap enough, 10% or whatever the number is, after it's rallied 200% or so. So to me, it's too much near-termism.
So give me a clue,
and
Greg.
I think it's missing.
Tell me what
the
you're
big
doing.
picture.
What are you doing right now?
So there's good news, bad news story. The bad news is that I do think the beta in the market, that valuations still have a way to go, but the dislocations are really becoming quite pronounced. And so what we're doing is relative value. And I know that sounds like a cheap phrase, but you look at the unevenness of the moves. Europe versus the U.S. and high yield, for example, even within emerging markets, should have LATAM traded off as much as it did. So we're really evaluating those relationships, but definitely not diving into the pool here. I think this is a volatile time, and we haven't really seen the repricing yet.
It's a delicate time, and I appreciate the time of all three of you. Thanks for being with us. Greg Peters, to Terry Jacobson, come back soon, please, and Jim Bianco of Bianco Research. Let's talk about